If you've clicked on this video, you're probably wondering, is Singapore real estate a good way to grow your wealth? In recent years, real estate prices have been climbing, but this trend actually goes back much further. In this video, I'll explain why this growth isn't coincidental. It's driven by strong, intentional planning. Many of these factors have been quietly executed right in front of us. And some maybe even your property agent might not have pointed out. By the end of this video, you'll learn 6 ways real estate in Singapore remains one of the safest investment options, and why this colourful map plays a big role in all of this. No investment is without its risk. I'll also discuss 4 aspects of Singapore real estate that makes it a bit riskier compared to something like stocks. The first reason why Singapore real estate remains one of the safest ways to build wealth is its strong track record. Historically, property prices in Singapore have performed well, growing at an average of 4% per year, while major stock indices like the S&P 500, which tracks the top 500 US companies, have grown by 8 to 10% annually. These two numbers are not a direct and fair comparison, as real estate typically involves leverage through a housing loan, which can help you compound your earnings much quicker. However, this loan comes with a risk. Therefore, the first reason why Singapore real estate may not be as safe a way to build wealth as many think is the uncertainty that comes with borrowing. A fixed rate home mortgage gives you certainty for the lock-in duration, which is typically anything between 1 to 5 years. But after that, it's up to the market. And as you've seen in recent years, rates can swing quite a bit. Take a $1.6 million condo, for example. Your monthly mortgage could vary significantly depending on when you refinance and what the interest rates are at that time. More importantly, you still owe your bank the installment, rain or shine. So while leverage can amplify your gains, it also amplifies the uncertainty, especially in the long run. But this uncertainty and even the ability to benefit from the leverage is just a symptom of something much deeper. It's not just luck or timing. To understand why property prices have risen consistently and safely over the decades, we need to look beyond the numbers and uncover these fundamentals which drive the price appreciation. The third reason why Singapore real estate remains one of the safest ways to build wealth is our limited land supply. While this is common knowledge, what many of us don't realize is how actively the government manages and controls the land release and supply. Land is released only when needed through the GLS or Government Land Sales Program, preventing an oversupply of new condos and keeping the supply in check. This is unlike something like the stock market, which isn't centrally controlled. In the later points, we'll explore how GLS is just one part of the government's broader role in shaping real estate stability. But land supply is only one part of the coin. In order to understand why real estate remains such a safe way to grow your wealth in Singapore, we also need to look at the demand. Due to our cultural values and how the public housing system is structured, Singapore has a very high ownership rate, around 90%, far higher than many other global cities. Coupled with the cooling measures over the years, demand remains organic, and more importantly, households are not over-leveraged. But these cooling measures can also be a double-edged sword, as we will soon see. If you're new here, my name is Daryl, and in this channel, we talk about real estate in Singapore. If you're watching this video, then you're probably interested in real estate topics relating to the Singapore market, and may also be interested in some of my other videos, which talk about the mistakes during the purchasing process, some budget-friendly projects near the MRT, or what makes a project so profitable. So remember to like and subscribe if you want more unbiased property videos. The second reason why Singapore real estate may not be such a safe way to build wealth is its illiquidity and high upfront cost. Unlike stocks, you can't liquidate your real estate piece by piece. It takes time to find a buyer, complete the sale, and then finally receive the funds. So if most of your wealth is tied up in real estate, you may end up being illiquid in an emergency. Another drawback in real estate is that while it may generate capital gains, these gains are not immediately spendable. And in many cases, your rental unit or investment unit may not even be able to generate any meaningful cash flow due to the high cost. I won't go into detail here as I've covered this fully in another video. Beyond liquidity, stocks also have the advantage of providing cash flow by distributing profits, or what we call dividends. And unlike real estate, you won't need to pay off your loan first in order to enjoy this cash flow. In order to understand why real estate may not be as safe as stocks when it comes to building wealth, let's explore the income potential from stocks. Take a $1.6 million condo, for example. The down payment alone is around $400K, and the buyer stamp duty adds another $60K. Without counting anything else, that brings your total to be around $460K of upfront cost. With $460K, you could invest in dividend-paying stocks. Companies in Singapore like the DBS or the Straits Times Index offer around a 3 to 4% dividend yield, which adds up to be around $18K annually. While this $18K is not 100% guaranteed, of course, it is 100% cash flow. One downside of dividend stocks, especially in Singapore, is that they tend to have weaker capital appreciation over the long run. But if your focus is on long-term capital growth, that does not mean that stocks is off the table for you. You could also consider broad benchmark-based US indices like the S&P 500, which generally offers stronger capital appreciation and is still considered relatively safe. Overall, stock investments require less capital upfront and remain far more liquid. But unlike stocks which are not influenced by the government and move freely based on market forces, Singapore real estate is carefully orchestrated to maintain market stability. But that stability also comes with some intentional trade-offs, which we would explore next. The fourth reason why Singapore real estate is seen as a safe way to build wealth is the market stability created by these cooling measures. Many people complain about the sky-high prices created by HDBs and condos, but often forget that this comes after 15 rounds of cooling measures over the last 16 years. Examples include the TDSR or Total Debt Servicing Ratio, which limits how much you can borrow, the Additional Buyer Stamp Duty or ABSD, which adds cost to owning multiple properties in Singapore, and the reduced LTV or loan-to-value limits, which require higher cash outlay. If you bought a unit or plan to buy one, you've probably been stung by some of these factors. They actually raise the barrier to entry. Yet despite all this, the market still remains very hot. Now just imagine what the market would look like without all these measures in place. To me, these measures actually make Singapore real estate safer. They show me that the demand is actually organic and not speculative. And with most buyers purchasing for own stay, there is less chance of a panic sell-off during a downturn. But this stability is unintentionally a double-edged sword. Let's now look at one way that these cooling measures may actually make Singapore real estate a less safe way to build your wealth. The third reason why Singapore real estate may not be such a safe way to build your wealth is the regulatory uncertainty caused by these cooling measures. To understand how this uncertainty makes property investment less safe, let's look at how these policies have played out over the years. For example, in July 2018, the government introduced yet another round of cooling measures. This triggered a rush of buyers to condo show flats like Park Colonial, scrambling to purchase units before midnight when the changes took effect. But this wasn't the most extreme case. To really see the impact, let's go all the way back to 2013. In late 2012 and early 2013, the government rolled out a wave of cooling measures. They introduced the TDSR, they also increased ABSD on second properties, and reduced the loan-to-value limit. And the scary part here is that these policies actually worked. Property prices in Singapore stagnated for years, with many attributing it to this 2013 slew of cooling measures. While these measures may stabilize the market by deterring speculators and increasing the barrier to entry, the thing is that they're fully controlled by the government. That means that change can happen suddenly and without investor input, making long-term planning a bit more difficult and introducing an element of uncertainty which you may not be able to account for. So far, we've discussed 4 ways that real estate investment remains a safe way to grow your wealth in Singapore. But let's take a step back and clarify what this safe really means. No investment is 100% guaranteed, but some can be considered less risky due to some inherent traits which we will continue exploring. Safe here doesn't mean that you would get rich overnight. What it does mean is that there is a less chance of you losing your capital based on track record. It's about long-term growth with some protection during downturns. When we say safe, we're not talking about zero risk. We're just talking about less volatility. The previous points have not fully addressed the underlying price drivers. To understand why Singapore real estate remains such a safe way to build your wealth, we now need to explore its most certain growth driver: the funding from the government. The fifth reason why Singapore real estate is considered the safest way to build your wealth is due to HDB grants. You may wonder how these HDB grants translate to price increase in the private market. Therefore, in order to understand why these government grants make Singapore real estate such a safe way to grow your wealth, we need to understand how these grants flow. When eligible buyers purchase a HDB, they usually get it below the market price, either through discounted pricing or HDB grants, or sometimes even both. HDBs in Singapore come with a 5-year minimum occupancy period, or MOP, after which buyers can sell their flats. Upon sales, these grants are returned to the CPF ordinary account of the buyer, while the profits and the discounts come back as cash. Buyers can then use these funds often for their private property upgrade. Some of these grants can range from anything between 60 to 100k for resale flats, while for BTOs or new flats, profits can reach a few 100k. This means that a significant portion of the down payment for the private property upgrade often actually comes from HDB profits or HDB grants. Since these HDB policies are always active, regardless of the economy, the flow of market from the government to the HDB market and eventually to the private property market is almost guaranteed. If you're interested how much these buyers can actually make after you deduct all the hidden costs, you can check out my video up here as well. This is not meant to be a political statement, but from a social perspective, this is one way the government is actually giving back money to the people. While it may not be its main intention, it is also helping to keep the private property market buoyant. However, I do see the government reading back on this through the implementation of the Prime, Plus and Standard HDB classification, which in short limits the amount of profit a buyer can reap. It's this steady flow of funds from the government to the HDB market, to the private market that makes Singapore property investment such a safe way to grow your wealth. However, this cash inflow actually brings up the price of private property, which then brings me to my next point of how this high commitment can impact your overall portfolio allocation. The fourth reason why real estate in Singapore may not be the safest way to build wealth is the concentration risk and lack of diversification. To buy a 3-room condo costing you around $1.6 million, we saw earlier that you need to commit around $460K of upfront cost. That $460K ends up being tied up in a single asset class and a single product. If you own an investment property, that concentration in real estate becomes even more. Now compare this to stocks. In stocks, you can diversify your investment across different stocks, different industries, and even different countries. You could invest in an index fund like the S&P 500, which includes the largest 500 companies in the US, or the Straits Times Index or STI, which tracks the top 30 companies in Singapore. While real estate in Singapore remains a strong investment vehicle, it requires significant capital contribution and doesn't offer much diversification. This makes it a slightly riskier way to build your wealth for the long term. Earlier, we discussed Singapore's limited land supply as a fundamental reason why real estate is a safe investment. But the limited land supply is only part of the equation. How the government manages it is just as important. The sixth and the last reason why Singapore real estate is still considered the safest way to build wealth is the government's urban planning. Recent developments that have boosted prices include developments like the Thomson East Coast MRT line, the Punggol Digital District, and the Bidadari Estate transformation. More importantly, the URA publishes a master plan outlining land use and town development in Singapore. These include things like zoning, plot ratios, and even future project plans. It helps investors anticipate development like new MRT lines, commercial hubs, parks, schools, or changes to nearby land use. Besides just being forward-looking, the master plan also adds an element of rejuvenation to ensure that land is always best optimized and that no estate is left too far behind. Overall, this URA master plan helps to add an element of predictability and clarity to buyers. Singapore real estate remains one of the safest and most reliable ways to grow your wealth. But that does not mean that it is perfect, guaranteed, or easy. Its strength lies in the intentional government planning, the limited land supply, and the strong household fundamentals, all of which create a stable environment for long-term capital appreciation. But it also comes with some downsides like high upfront costs, low liquidity, and concentration risk. Like stocks, it all comes down to choosing the right project with the right plan. This investment topic is a very vast one and we've barely scratched the surface here. We've not even covered things like the 99-year lease and a forecast and comparison between stocks and real estate. So if you want to stay updated on topics like this, remember to like and subscribe. Now that you understand why Singapore real estate is such a strong wealth building tool in Singapore, you can check out my next video which talks about 3 risks of buying a condo in today's market.